While everyone has been distracted by the noise of stuff like the prospect of World War III, governments around the world have been silently building their dystopian central bank digital currencies. A recent report found that nearly 100% of central banks are now exploring CBDCs in some capacity. Not only that, but most of them are planning on rolling out their CBDC by the end of this decade. This begs the question of what exactly the central banks are planning, when exactly their CBDCs could be rolled out, and how you can protect your financial freedom. Today's video has all of the answers. The report that we will be summarizing today is titled, and I quote, "Embracing Diversity, Advancing Together." The result of the 2023 BIS survey on central bank digital currencies and crypto. It was published by the Bank for International Settlements, or BIS, the Bank of Central Banks. Now the report begins with a brief introduction, where in the author's note that the survey conducted took place in 2023 and involved 86 central banks. Notably, the survey includes questions about why central banks are interested in CBDCs, whether they're interested in stable coins. For context, most stablecoin functions actually identical to CBDCs. The main difference is that stablecoins are issued by private companies, whereas CBDCs are issued by, you've guessed it, central banks. Besides that, both of them have the same qualities in terms of being able to track and freeze transactions. Another difference is that stablecoins are backed by government debt. Well, this makes stablecoins a sneaky way for governments to subsidize their spending, because they can effectively trick their citizens into using government debt as a form of payment. So far, it's mostly crypto traders that are falling for the trap. Anyways, the authors then go on to explain what CBDCs are and highlight the difference between retail CBDCs and wholesale CBDCs. As some of you will know, retail CBDCs will be used by regular people, like you and me, whereas wholesale CBDCs will be used by select individuals and institutions. In other words, two CBDC system, one for them and one for us. Not surprisingly, the prospect of a two-tiered CBDC system and CBDCs in general hasn't been popular with the average person. This is why central banks and governments both seem to be warming up to the idea of stable coins as an alternative. We reiterate that stable coins are functionally identical to CBDCs. Per the report, and I quote, over the course of 2023, various banks and other traditional payment service providers started to use stable coins for their activities or to issue stable coins to their customers. The authors go on to know various stable coins and experiments involving PayPal PUSD and Circle's USDC. Speaking of which, you should know that Circle CEO Jeremy Lay tactically admitted in an interview that Circle's endgame was to turn USDC into a de facto CBDC. I will also note that the World Economic Forum has been working on a synthetic CBDC, which combines stable coins with CBDCs. By the way, if you are enjoying this video so far, smash that like button and subscribe to our channel so you don't miss any important videos. Now, in the second part of the report, the authors give some details about central banks that were involved in the survey and the CBDCs, also stablecoin. The map of participating central banks can be seen here. It doesn't look like much, but it covers 81% of the world's population. Regarding the responses, the authors provide a visual breakdown of what kinds of CBDCs these central banks are focused on and what stage that development is at. Unfortunately, most of them are working on both wholesale and retail CBDCs. Fortunately, only a few are at the pilot state. Most are still being researched. The best part is that most of these CBDC pilots are related to wholesale CBDCs, not retail CBDCs. As you can hopefully see, the number of retail CBDC pilots actually seems to have flatlined over the last few years. This underscores the fact that CBDCs are becoming increasingly unpopular with the public. On that note, you should know that the totalitarian qualities of CBDCs aren't the only reason why central banks are struggling to roll them out. There is also significant technological hurdles and risks. As you can imagine, CBDCs are top targets for hostile countries, and they aren't exactly easy to build. Most importantly, before you can roll out a CBDC, you need to roll out a digital ID. This is a biggest part of why digital IDs should be opposed. They're required for CBDCs to function. No digital ID means no CBDC. Newsflash. This is why the EU has been rushing to roll out digital IDs. The Estonia Central Bank is looking to roll out its digital Euro CBDC. In the next 2 years, a CBDC is probably the only way it can prevent the euro from imploding, given the divergent fiscal and monetary policies of Eurozone countries. That's a topic for another time. This ties into why exactly central banks are exploring CBDCs. The authors start by revealing that central banks believe that rolling out both retail and wholesale CBDCs is very important. Here's the reason why. The BIS found exactly what I just said. They are worried about their national currencies being replaced. Specifically, central banks are worried about their national currencies being replaced by, and I quote, new form of privately issued money. This is code for not just stable coins, but also cryptos in general. Obviously, stable coins are perceived as the bigger threat, due to their similarities to fiat currencies. Imagine a scenario where the euro starts to rapidly lose value due to the, as I mentioned, divergence between monetary and fiscal policies of Eurozone countries. Most Europeans would probably look for somewhere else to keep their money safe. Many would probably choose US dollar stablecoins. This would be a bigger problem than you think, because it would mean that any effort the ECB would take to stabilize the euro would fail, due to the competition has been noted by the ECB and others. The only solution, then, is to restrict what people can do with their money. And this is precisely what CBDCs are designed to do, to limit what you can buy and when you can buy it. Now consider that the ECB implied in its first digital euro report that it could replace stores of value like gold. In simple words, the ECB, you won't be allowed to buy gold with digital euros. But of course, the ECB's tone has softened since that first report. Now this relates to when central banks could start rolling out their CBDCs. According to the BIS survey, most central banks are focused on launching wholesale CBDCs in the medium term. What's interesting is that fewer central banks are signaling this than before, suggesting they're encountering technical hurdles. The breakdown of when central banks expect to roll out retail and wholesale CBDCs is eye-opening, to say at least. It shows most central banks don't see retail or wholesale CBDCs rolling out in the short term, and while many believe it's possible in the medium term, very few believe it's likely. Short term means 1 to 3 years, whereas medium term means 4 to 6 years. The key takeaway, then, is that central banks don't think they'll be rolling out any kind of CBDC anytime soon, which is certainly good news. The bad news is that few big central banks expect to launch retail and wholesale CBDCs in the short term, the most notable example being the ECB with the digital euro. And if you think about all of the stuff about retail CBDCs being dystopian, is FUD or fake news? Consider the title of the following subsection, and I quote, likely retail CBDC features, limits on holdings, domestic interoperability, offline functionality, and non-remuneration. Now, a breakdown of all of the features of retail CBDCs can be seen here. You will notice there's quite a bit of uncertainty about whether they should be included. Besides limits on balances, controls include limits on transactions, obligations for merchants to accept, programmability, and embedded capital flow. Programmability means that CBDCs could be designed to, say, prevent you from buying certain amounts of meat or alcohol or whatever else. Embedded capital flow means your CBDC holdings will be automatically swapped for another currency or asset under certain conditions. I'll quickly note, the ECB has written extensively about these so-called waterfall features. Another alarming feature for retail CBDCs is the fact that people won't need a bank account to access them, a feature that central banks overwhelmingly support. This is alarming, as it implies wide-scale digital ID rollouts. After all, how will they verify your identity for a CBDC without a bank? Digital ID is the only way. For anyone wondering whether these CBDCs will somehow leverage crypto, the answer seems to be no, as most central banks are opposed to using distributed ledger technologies for their CBDCs. What's fascinating is that central banks in developing countries seem to be open to embracing crypto tech. Just a reminder that when cryptocurrency uses blockchain, it's a good thing. When government or central banks uses blockchain, it's a bad thing. Blockchain is a powerful tool that can be used for slavery or for freedom. Crypto uses blockchain for freedom. Central banks and government use it for slavery. Now, when it comes to the kind of features central banks wants for wholesale CBDCs, there isn't too much to note. Central banks seem to want everything and more, but it's irrelevant as wholesale CBDCs won't be used by you and me again. They'll be used by select individuals and institutions. By this point, you might also be wondering, what central banks want their CBDCs to be used for? This is addressed in the next part of our 911 crypto report. As expected, the focus for retail CBDCs is peer-to-peer and government payments. Also focus for wholesale CBDCs is into bank and foreign exchange payments. That reminds me, requiring a retail CBDC to pay taxes is one approach that many governments are likely to take to force their populations to adopt their dystopian digital currencies. The catch is, you can easily force adoption, but it's going to be very difficult to force data use outside specific settings. Look no further than Nigeria for evidence of that. The government couldn't even force the adoption of the Naira CBDC, despite restricting cash flows. Anyhow, as always, the entities that will be helping central banks and governments roll out their CBDCs are so-called stakeholders. For reference, the term stakeholder seems to have its roots in the West crazy idea of stakeholder capitalism, and it's basically a code for powerful individuals and institutions. Unfortunately, the authors don't give too many details about the stakeholders involved in the CBDC rollout, noting unspecified public authorities, payment technology companies, and commercial banks. It's safe to assume that any of the above institutions affiliated with the WEF are involved in CBDCs. In case you didn't know, WEF is working closely with the UN to achieve its Sustainable Development Goals, or SDGs. The SDGs required the rollout of the things like digital IDs and CBDCs in every country by 2030. Note that the list of institutions involved in this pilot include crypto projects such as USDC Issuer Circle. This pertains how central banks are approaching stable coins. The authors confirm that most central banks are developing CBDCs due to the concern that a stable coin could displace their domestic currency. Once again, this implies that CBDCs will be used for control, as once admitted by the ECB's president. You might also recall that so far, stablecoin use has been limited to crypto traders and alike. This is confirmed by the survey of central banks conducted by the authors, which revealed that only a small fraction of people is using stable coins for payments. Then again, they admit they can't say for sure. What's funny is that the authors claim that the adoption of stablecoins can help central banks better understand how to ensure the adoption of CBDC. This is funny because the main reason why stablecoins have so much adoption is because they're perceived to be less controlled than CBDCs. In any case, the authors reveal that more than 60% of survey jurisdictions are in the process of rolling out crypto regulations. If you've been keeping up with our coverage on crypto regulations, you will know this is a double-edged sword. On one edge, these crypto regulations are likely to be very restrictive. On the other edge, however, these crypto regulations will result in more inflows into the crypto market. This will increase the amount of lobbying around crypto regulations, which should eliminate most of the worst restrictions. Zero privacy regulations will probably be the first, as big investors want privacy. The fact that half of the survey jurisdictions are planning custom crypto regulations is a promising sign to this end. For those who don't know, most crypto regulations are designed to absorb crypto into the existing financial system. Creating unique regulations for crypto makes it possible to avoid this. This is presumably why the authors warn that it is paramount for countries to conform to the global crypto regulation recommendations given by the likes of the Financial Action Task Force. The fact the authors feel compelled to give this warning confirms that countries are going their own way. This brings us to the big questions, and that's what you can do to stay financially free. If you believe a CBDC is imminent in your country or region, this applies to most of those living in Europe. As the digital euro seems to be just around the corner, you may not need to move, but you do need to have the opinion to. This pertains to the fourth way to stay financially free, and that's to advocate for alternative technologies. The problem is that some alternative technologies like stable coins are very similar to CBDCs. On plus side, they should be much less dystopian than CBDCs. If there's a free market, that's just because in a free market, stable coins with too many restrictions will not be adopted by the average person. They will naturally gravitate to whichever stable coin give them the most freedom. If all stable coins end up with restrictions, then they could very well start using other cryptocurrencies like BTC. Now, the final way to be financially free is the most difficult, but will guarantee your freedom. That is to help create digital currencies that preserve our collective financial freedom. As the saying goes, if you want something done right, You've got to do it yourself. Creating a digital currency is a dating task, but it can be done, and if you succeed, then you could find yourself incredibly wealthy. The trade-off is that you're likely to make lots of enemies in the process. You know, central banks, commercial banks, governments, Gary Gensler, the list really does go on. The truth is that such conflict is inevitable, especially when you have lots of money and influence. Central bank seems to be focused on wholesale CBDCs and are nowhere close to launching their retail CBDCs. By the time they're actually developed, it's likely that actual free digital currencies, like certain cryptos, will be large enough to make CBDCs irrelevant. If the BIS reported, the pace of CBDC development will depend on how threatened central banks feel by stable coins and the like. As stable coins and other cryptos continue to grow, so too could the development of CBDCs and an epic battle between good and evil. Just don't forget that not all crypto projects are on the good side. Well, that's all for today's CBDC episode. If you found it informative, be sure to smash that like button. If you want to stay informed, subscribe to the 911 Crypto channel and ping that notification bell so you don't miss the next important report.